The financial crisis of 2008, widely known as the Great Recession, was a catastrophic global economic downturn that reshaped financial systems and devastated millions of lives. Its roots can be traced to the housing market in the United States, where an unsustainable bubble had formed over years of reckless lending and speculative investment. Banks, driven by profit motives and emboldened by deregulation, issued an enormous volume of subprime mortgages, high-risk loans granted to individuals with poor credit histories and limited ability to repay. These loans were predicated on the assumption that housing prices would continue to rise indefinitely, ensuring borrowers could refinance or sell their homes at a profit. This speculative optimism, however, proved disastrous. Subprime mortgages were repackaged into complex financial products known as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. These instruments were sold to investors worldwide, from pension funds to global banks, on the promise of high returns and low risk. Credit rating agencies, whose business depended on fees from the very institutions they rated, contributed to the problem by assigning top-tier ratings to many of these securities, even when they were laden with risky subprime loans. At the same time, deregulation had weakened safeguards that might have mitigated the crisis. For example, the repeal of the Glass-Steagall Act in 1999 allowed commercial and investment banks to merge, increasing systemic risk as institutions became too big to fail. By 2006, cracks began to show. Housing prices, which had surged for years, started to decline, making it impossible for many borrowers to refinance their loans. Delinquencies on subprime mortgages soared, triggering a wave of foreclosures. The value of mortgage-backed securities plummeted, revealing the fragility of financial institutions that had heavily invested in these assets. Panic began to set in. Banks and investors, unsure of the extent of exposure to toxic assets, drastically reduced lending. This freezing of credit markets led to a chain reaction. Major institutions, such as Bear Stearns, were either forced into fire sales or bankruptcy. In September 2008, Lehman Brothers, one of the largest investment banks in the world, declared bankruptcy, marking the most dramatic moment of the crisis and sending shockwaves through global financial markets. The collapse of Lehman Brothers triggered a full-blown credit crunch. Banks stopped lending to each other, fearing insolvency, while businesses and consumers struggled to secure credit. Stock markets plunged, wiping out trillions of dollars in wealth, and unemployment surged as companies slashed jobs to survive. The crisis quickly spread beyond the United States, impacting financial institutions and economies worldwide. European banks, heavily invested in U.S. assets, faced similar collapses, while export-dependent economies, like China and Germany, suffered from the dramatic drop in global demand. The interconnected nature of modern economies became starkly evident, with no country spared from the fallout. Governments and central banks around the world intervened with unprecedented measures to stabilize the financial system. In the United States, the Bush administration introduced the $700 billion Troubled Asset Relief Program, TARP, aimed at recapitalizing banks and purchasing toxic assets to restore confidence. The Federal Reserve slashed interest rates to near-zero levels and launched quantitative easing programs to inject liquidity into the economy. Other central banks, including the European Central Bank and the Bank of England, followed suit. Simultaneously, fiscal stimulus packages were rolled out to prop up struggling economies, from infrastructure investments to direct financial support for households and businesses. Despite these efforts, the recovery was slow and uneven. Millions of people lost their homes to foreclosure, their jobs to layoffs, and their savings to stock market collapses. Entire communities were devastated, and public trust in financial institutions and governments eroded significantly. In the years following the crisis, governments introduced sweeping regulatory reforms to address the systemic failures that had caused the meltdown. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 imposed stricter oversight on banks, increased transparency in financial markets, and sought to reduce risky practices. Stress tests were introduced to assess banks' ability to withstand economic shocks, and capital requirements were increased to ensure institutions maintained sufficient reserves. Globally, the Basel III framework was adopted to strengthen the regulation and supervision of banks. Despite these reforms, the long-term effects of the crisis continue to shape the global economy. Wealth inequality, which had already been growing, worsened as the recovery disproportionately benefited the wealthy. Political discontent surged, giving rise to movements like Occupy Wall Street, which protested corporate greed and economic inequality. The crisis also fueled a wave of populism across the world, as ordinary citizens demanded accountability and sought radical changes to economic systems perceived as rigged in favor of elites. The 2008 financial crisis serves as a stark reminder of the perils of unchecked speculation, inadequate regulation, and the dangers inherent in a highly interconnected global economy. While the reforms implemented since then have strengthened financial systems, debates persist about whether enough has been done to prevent a similar catastrophe. Its legacy is a world more aware of economic vulnerabilities but still grappling with the societal and political repercussions of a crisis that reshaped the 21st century.